Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We're counting down to the next VRIC, January 21st and 22nd. Tickets are in the description below. But for now, we're bringing the VRIC to you with our expert series of online panels. And we have a great one lined up for you today. We're speaking with Michael Pento from Pento Portfolio Strategies and Todd Horwitz from Bubba Trading. Gentlemen, it's great to have you on the show.
Great to be here. Glad to be back.
Thank you for having me very much.
Yeah, happy to have you both here. Very excited for this panel. And I want to get started with some recent news about the US, potentially the government shutting down. A bill has now been passed as of today, signed by President Biden, some sort of laddered spending plan to avert a government shutdown. Here's a quote from an article about it. The legislation would continue funding the US government at its current 2023 levels until January 19th for agencies including Veterans Affairs, the Food and Drug Administration, Transportation, Housing and Urban Development, and Energy and Water Development. What are your thoughts here? How serious is this situation? How longer can these sorts of things keep happening before something really breaks? And Todd, I'll go to you first on this one.
Well, Jesse, that they can do this as long as they want. I mean, basically, we know the government creates nothing but debt. And as long as they have the American taxpayer and the American taxpayer has money, they can continue to extend the debt ceiling. It's so ridiculous that if any one of us here on this panel spent like the government, we'd be in bankruptcy court or jail. And it's really getting sickening to watch them throw away our money on garbage that is absolutely cannot be done, from the climate change agenda, because they haven't fixed the infrastructure. If they would spend the money where it's supposed to go instead of lining their own pockets, there wouldn't be this much issue to deal with.
And Michael, what are your thoughts on this whole situation and how it could potentially affect the economy as well?
Well, it already is affecting the economy. If the U.S. government was a person or an entity entering a banking system and saying, "Can I have a loan?" they would throw them out on their butt. Listen, the national debt is now $34 trillion. And the interest on that debt is $700 billion a year. It's going to be $1 trillion by 2025. So entitlements and interest payments on that debt is going to be 100% of all of our revenue to the Treasury by 2040. So I guess the only option here is that the Fed is going to have to monetize this debt on a perpetual basis, causing never-ending inflation. That's the sad truth here. And you know what you get when you have modern monetary theory? You get stagflation. It's the end of productivity. This is a disaster for America. But you still hear academics. I even heard someone today, before I came into the office from home, talking about how much debt doesn't matter. In fact, this person wrote a book about it. I think it's called the debt or deficit myth. I mean, my God, listen to a couple of facts here. Our national deficit, just the deficit I'm talking about here, not the debt. The deficit is 45%, so almost 50% of our entire revenue. And the national debt is 770% of our annual federal income. I look at those metrics because you can't tax 100% of GDP. So the debt as a percentage of GDP is at an all-time record high. I get that. But you can't tax your way out of this situation, because if you raise taxes, Arthur Laffer-Napian proved this. I mean, his theory is true. If you raise taxes to 100%, who is going to work? So it's the debt and deficits as a percentage of revenue, and it is a disaster. And I just want to button up this last answer to this question with this thought. When the reverse repo facility runs dry, and I think it runs dry in March, according to the vector in my calculations as to when this RRP facility runs dry, the liquidity in the bond market then runs dry, and the liquidity in the bond market is almost already completely evaporated. So think about the fact that the U.S. Treasury market trades like a small cap pink sheet stock. I mean, yields are going up and down violently every day. And that's when you still have $1 trillion or 900 billion in the reverse repo facility. When that runs dry, those excess reserves are gone, then you could really start to imagine how disastrous the situation with the U.S. debt is really going to be, because there's nobody buying it anymore. Japan doesn't really want to buy it anymore. China doesn't really want to buy it anymore. The Fed is selling treasuries through its quantitative tightening program. So who's left, and at what price, and at what yield?
And so I'd like to ask how people can make sense of all of this, because it seems like just intentional incompetence. There has to be, however many PhD economists are employed at the Fed, not to mention other central banks. A similar situation is playing out in the Eurozone as well. How is it that they're not seeing this? Are they seeing this and just not paying attention? Is this related to political cycles? Is it just that the people in power, they're just looking at their own election cycles and at getting back into power? They could care less about what happens to the broad economy. Is this pure malice and evil? There's the theory out there that this is all being executed intentionally to reset the system and bring about a CBDC or some other extra element of government control. Todd, I'll go to you. What are your thoughts?
Well, I think almost everything you said is correct. I mean, let's if we go back to the Federal Reserve or the central banking system, which started in England in the 1600s, they've been stealing ever since. You may be very well educated as a student, but as a student of monetary policy and as of running an economy, they have no common sense. We're dealing with a bunch of morons that are just simply stealing the money and stealing it through taxes, stealing it through printing. The money supply is massive, which is one of the reasons that is keeping the equity markets afloat at this point in time. We have a bunch of people that have no idea how true markets work, how real true price discovery works, and how we look into an economy. They continue to think that they can buy their way or borrow their way out of debt, which is never going to happen. As Michael said earlier, the inflation is going into stagflation, which is going to kill the economy. If you continue to raise taxes, how much am I going to want to work to go ahead and so I can make money for a government that doesn't care? And it's not just this administration, as bad as they are. This has been going on for years and years as we continue to see the Fed that should not be involved. And at least if we're going to have a Federal Reserve, we should have a true audit of an independent auditor telling us what they're doing with our money, because it is our money. The Fed and the government create nothing but debt. They create no product. They create no income.
Michael, your thoughts. Is this ignorance? Is this malice? Is it somewhere in the middle?
I don't know how nefarious this really is. I think it's more about hubris and arrogance. Hey, we're just dealing with politicians now. There is no free market any longer. Markets have been abrogated and become completely artificial. It's all fake. Look at Japan right now. It's not just America. I'm not just picking on America right now. Look at Japan. There's no market for JGBs, Japanese government bonds. The only market there is from the Bank of Japan. You have to print money to keep rates down, but that keeps inflation higher and higher, and that forces rates up. It's a dysfunctional market, and it's all about, again, our arrogance and hubris. Let's try to make interest rates low so everybody can afford a house. The road to hell, paved with great intentions. Now the average home price in the United States is at the highest as a percentage of income that it has ever been before, including the peak in 2005. So first-time home buyers can't afford a house. And inflation, which was rising at, the way I calculated, 17 to 20%, the way the government calculated at 9%, it's now coming down to a rate of 3.2%. Well, whoop-de-doo. But prices aren't coming down. In other words, prices are unaffordable for the middle class of the country. Well, here's the good news for the middle class. They're going up further, but at a slower rate. Aren't you happy? So to me, it's I don't know how evil these people are. I don't know how nefarious they are. I just think they are feckless politicians who have destroyed this country, just like the countries of Japan and the Eurozone and China are destroyed as well.
That makes a lot of sense. And I want to discuss central banks cutting rates, because globally, central banks are cutting rates at the fastest pace since August of 2020. So, do you expect the Fed and the ECB to be forced to follow suit at some point? And what would that mean for inflation? And Michael, I'll go to you first on this one.
Okay. So the most important central banks in the world are not cutting rates. The Fed and the ECB perhaps have stopped raising rates, but they're still engaged in quantitative tightening. And the People's Bank of China has trimmed its prime lending rate from 3.7% to 3.45%. So we're not talking about massive rate cuts in the what I call the G3, the biggest three economies on the planet. But all the big central banks, we're talking about the ECB and the Fed, their mantra is higher for longer. I expect the Fed and the ECB to be very reticent to lower interest rates until the credit markets freeze. And then once they freeze, they're going to be tripping over themselves to lower interest rates back to ZIRP, back to QE, because you can't have an economy with this much debt. And the level of these asset bubbles just cannot exist when you can't float commercial paper, when the repo market freezes. So they're going to be aggressively lowering interest rates. But then think about this, Jesse, and Todd as well. If the Fed has to go back into QE and ZIRP about a year or two after inflation was 9%, and they said we have to aggressively start fighting inflation after it appeared it wasn't transitory after all, who in God's name is going to have credibility with the Federal Reserve? Who is going to believe that the Federal Reserve can ever adequately fight inflation? In other words, bring interest rates to a real number, a real figure, nominal minus inflation. It just can't happen without destroying asset bubbles and destroying the economy. And everybody's going to know it. They will fool no one. So when they are able to reliquify the credit markets again, and then Powell's going to say, what? Maybe it's time to raise rates? It'll fool nobody. It's going to be protracted and inexorable stagflation. And that's where I think we're headed for a very long period of time after this next iteration of bubble collapse occurs, which I think is coming soon in 2024. We can get into that later if you want to.
Yeah, definitely. Todd, your thoughts. Do you think this higher for longer mantra is going to hold until they break something such as the credit markets freezing, as Michael alluded to?
Well, I believe that if you listen to Powell, what he says, which is totally ridiculous, because I thought he'd be a good candidate because he was from the real market, but when he got there, he forgot what the real markets were like. I think that they're going to have to continue to hike rates. I see the 10-year going to 6%, if not higher, because again, they can't, this inflation is not under control. It wasn't transitory then, it's not transitory now. And because they exclude the biggest cost for Americans, which is food and energy, it counts as such a small piece of inflation. I mean, that is our number one cost unless you have an emergency. And if those things aren't coming down, you've got big problems. Now you take a look on the production end from the farming side of the world. Farmers are getting killed. They can't afford the input costs. They're planting at a loss. And I would be very surprised if they plant full crops next year because they can't afford it. The banks are going to hold them to hostage because the interest rates are so high. And farmers don't pay what you and I pay for interest rates. They pay 2 to 3 points higher because of the risk capital that goes with it. So they're getting killed. The retailer is making money. The buyer, us, can't buy them because it's too expensive. And in the meantime, we've got this ridiculous fuel cost in between, which 80% of this country works on fossil fuels. And until we find a solution for fossil fuels, we should not be paying the prices that we're paying. So the rates are going higher because the Fed can't keep this thing under control. And of course, interest rates are going higher, which will create the massive collapse. And of course, the housing bubble, if it's not here now, it's going to happen again. And this will be like a rerun of 2008.
I'm Jay Martin. On November 30th, I'll be hosting an exclusive live online video event called Crisis and Chaos, The Changing World Order. I'll be joined by some of the world's top military experts, geopolitical analysts, and economic advisors. They'll be answering my questions and yours about the cascade of global crises since COVID-19. This event is for anyone trying to make sense of our crazy world. Find out what could be coming next and how you can prepare your mind, your money, and your family. Crisis and Chaos, The Changing World Order, an exclusive live online video event on November 30th. Click below to purchase your ticket now.
Well, Michael, I'd like to hear your thoughts on the housing market to follow up on Todd's comment there. Both commercial and residential real estate, how is that connected to the broad economy? And are you seeing any signs there that present distress in your view?
Absolutely. That's why I think I respectfully just tell Todd that I don't think the Fed can raise rates much higher at all. I think they're done because banks right now are insolvent. Their assets are yielding them. Their assets, CMBS and mortgage-backed security, are yielding them around 3% on average. But they have to compete with a 5.5% T-bill. So they can't hold those deposits. So there's been a run on the regional banking system. And those deposits could flow to JP Morgan for sure. But guess what? They still have to pay 5%, JP Morgan does, to keep those deposits there. And the Fed keeps raising interest rates. And don't forget, the Fed raised interest rates from minus 8% in a real sense to positive 2% in the course of just a couple of years. I will remind everybody that in 2018, the Fed took interest rates to 2.5%. And then they had a promise to stop raising interest rates because the repo market froze and the credit markets were freezing and the stock market went into free fall. So I don't think they can go much higher. Maybe Todd's right. They can go maybe 1 or 2 times more at the most. But I fully expect disaster to arrive to the fullest extent before then. And what's going to put Powell on ice, put the ECB on ice. I think they're already there, to be honest with you, because the deterioration in the credit markets is just around the corner. And you could talk about the weakness in the labor market. You could talk about the weakness in some of these earnings reports that are coming out. Even Walmart's saying, hey, listen, we see deflation now in prices. And what the Fed fears most of all, what does central banks fear most of all? It isn't inflation. That's where they're headed. What they fear most of all is deflation, because deflation is the natural gravitational force of what happens after you rapidly inflate. And what the heck have we done in the past, 14 years? I mean, interest rates have been 1% or less for 11 of the past 14 years from 2008 to 2014. That has never before been even fathomed in the world of fiat currencies. I mean, do you know that there was $17 trillion worth of negative yielding debt on the planet Earth just a couple of years ago? In other words, you got paid to borrow money. This is how far we've come from 2013, the Federal Reserve Act. This was supposed to be a lender of last resort for the banking system, for banks to access the discount window, which was a haircut on treasuries. It wasn't supposed to be a system in place that papered away every downtick in the stock market or every, blip down in GDP. That's because it's become a political enterprise. And you went away from gold as a standard. Why gold? Jesse, why gold? Why did the founding fathers say that only gold and silver is money? Is because the mine supply of gold is pretty much commensurate with the growth rate of GDP, which happens to coincide with productivity plus labor force growth. Oh, what a wonderful world that is. So base money supply can only grow commensurately with GDP. So there's no chance of asset bubbles. There's none of this interest rate volatility. But we've gone so far away from that, where you took base money supply, high-powered money, which is physical coins and currency, and bank credit, okay, Fed credit. You've taken that from $700 billion in 2008 to $9 trillion by 2020. What a disgrace. Goodbye, middle class. That's what the Fed and the ECB and the PBOC and the BOJ, they're all together. They all sing from the same hymnal. I know I'm rambling, but I'll just end with this thought. Where the hell did they get 2% inflation target from? Where did that come from? I thought central banks were there to provide stable prices, which in my mind and in everybody else's mind up until Bernanke was 0% inflation. Now you can't. Now they all sing from the same hymnal that if you don't have 2%, the global economy melts down, doesn't function. 1.9% isn't good enough. So you have to keep printing and lending until you get 2%. And then guess what? You don't stop at 2% because they have no damn idea how to control inflation. They don't even know how to measure it. They don't even know where it comes from. They figured out it was helicopter money. Oh, that's how we get inflation. Wow, that's wonderful. Tell people to stay home, print up a bunch of money, right? Hand it to them and have the Fed print it all. Hand out checks from the government. That's how you get inflation. But inflation doesn't stop at 2%. It goes to 20. So I'll end with, I know I rambled, so sorry.
So that's what happens when they run a fraudulent fiat currency system, which has no backing. And of course, if you look back in history, Alan Greenspan, who was the originator of these asset bubbles, said that before the gold standard, when we were on the gold standard, he fought against going off of it. The minute he became Fed chair, he said, oh, no, we don't need to be on the gold standard because, of course, he recognized the power that he had and the ability to create these ridiculous asset bubbles and the imaginary world of free money, which we all know that money is not free and that we need to have some backing, because with what's going on now is exactly what Michael said. It's going to be disaster. There'll be no middle class. There'll be the very wealthy who are loving this because they're benefiting from what's going on, and the very poor.
Yep. Well said, Todd. Yeah. They have a tool, a fiat currency. They all became politicians and forgot about how to be a real economist. This is what we have.
Howard Marks has recently talked about the fact that this era of ultra low interest rates is perhaps the most significant development when it comes to investing over the course of the last several decades. And now that situation is reversing, but he points to the fact that it is responsible for a lot of the inflated value in assets, including the stock market. So I'm wondering what your thoughts are right now on the broad market, because it seems to keep steadily ticking up. And we're hearing all sorts of, mainstream financial talking heads saying how great things are. The new bull market has arrived. Everything's great. And they don't seem to see the danger right in front of their faces, or maybe they don't want to, or maybe they do see it and they want to lie about it. So I want to get your thoughts on the broad market here. Obviously, a small handful of stocks holding up the S&P and the NASDAQ. How long can this go on for? Todd, I'll go to you.
Well, I mean, obviously markets can go longer than we think they can go. But of course, the agenda of the talking heads on TV is to continue to promote buying, because that's what they make their commission. Let's be honest about what they're doing. They're there. That is the same reason as the risk on, risk off trade came in. I mean, if you truly knew which stocks to buy when it was riskier or less risky environment, then you would never have to worry about ever losing money in the stock market. Okay. So if we look at the overall picture, the overwhelming money supply continue to pump it up. The asset bubbles that are being continue to be perpetuated here with the cheaper money is keeping it up. Look at what's happening now. The volume is dried up. The markets are as illiquid now as they've ever been from an actual volume standpoint and a price action standpoint, because we don't have true free market price discovery anymore, as Michael pointed out, I don't know, about a half hour ago, but we have no real true free markets with what's going on because there's too much Fed and government manipulation trying to play these markets. And Ben Bernanke proved it best in May of 2013 when they started to hike rates, and suddenly the markets fell hard, and they had the Bernanke panic, and he went back to the same pattern, which is basically destroying the overall economy, destroying the money and the markets. I don't think the markets have, another month, 2, 3, 4 months. I've thought and felt for the last year that we're going to see a haircut of 50 to 70%. I still think it's coming, but I can't tell you when.
Michael, the markets can remain irrational longer than you can remain solvent. Is this that situation? We saw Michael Burry recently close his short position on the broad markets. How much longer can this go on for?
Well, there's so much to say here. First of all, I manage money for a living. So I own an RIA, and my money's in there too. So we should all just calm down about how wonderful the stock market is. Because let me just give you one data point before I unfortunately have to expound on the very long answer here. So far, Global debt is now at $300 trillion. This is what happens when you take interest rates to 0% and leave them there for a decade or more. $300 trillion is 350% of global GDP. That is 26% higher, not 26 percentage points, 26% higher than it was just before the global financial crisis. So we have a tremendously unstable foundation for the equity market. And people say, this is what drives me crazy. Getting to your answer. People say, oh, well, Mr. Pento, you're bearish. Well, you've been bearish. Well, guess what? First of all, I am bullish and bearish at different times. Okay, I have a 20-point model called the inflation deflation economic cycle algorithm. It's a model that I created. I've been in the business for 33 years. So sometimes I short the market, sometimes I'm long the market. But let's just look about what happened over the last 4 years, 4 or 5 years. 2018, the stock market dropped 20% in just a matter of a few weeks. You remember the fall of 2018 where the Fed had to stop raising interest rates? Now, I don't want to suffer a 20% decline. That would be a disaster. For 10% in my assets is a disaster. Oh, okay. What about any other examples, Mr. Pento? How about 2020? 2020, the stock market dropped 30% in the first few months of 2020. Oh, that was just because of COVID. You were lucky. You got, my model picked up that COVID was going to be a huge problem in January. Okay. So you have any other examples? What about 2022? Another 30% drop from the start of the end of 21, start of 22 to October, the market lost 30%. That's another disaster. So as Todd was just talking about, it's not like it hasn't happened. These aren't like fat tail events that never occur. I'm not just talking about 2000 when we lost 50% in the S&P and 83% in the NASDAQ. I'm not just talking about 2008 when the S&P dropped over 50%. I'm talking about the fact that we have so much debt and it's such an asset bubble driven economy that these collapses, 2018, 2 years later, 2020, 2 years later, 2022, and 2024, you're going to see 30, 50% collapses. And if the market forces were allowed to actually function freely, in other words, the Fed is really, truly serious about fighting inflation, which I don't think they are, because when the repo market freezes and the credit markets freeze, they have no choice but to pursue inflation. But Todd would be right. The market would drop 70%, if not more, to bring it back into parity. If you look at, and we'll get maybe into that a little later, but the stock market right now is more expensive than any other time in history prior to 2020 by a lot. So there's a whole heck of a lot of downside to come. But and again, I'm sorry for going long, but this you asked a question that really it tugs on the heartstrings here. The labor market is weakening. People go on CNBC, Bloomberg, and mainstream financial media talk about how strong the labor market is. So far this year, job cut announcements are up 198% from last year. The household survey, which leads the establishment survey in the non-farm payroll report, 348,000 jobs were lost, Jesse, not gained, lost. Now, why else do I think that the economy is about to falter in 2024? The forbearance programs for mortgage, like FHA insured mortgages, they end November 30th. Student loan repayments, as you know, September 1st, they ran out, but that's not a big one for me because it doesn't ding your credit. Joe Biden said, "Oh, you know what? You don't have to pay your student loan back. We won't even report you to the credit agency." So maybe that's not a big one. But the FHA forbearance, 17% of all mortgages now are FHA secured. These people haven't made a mortgage payment since early 2020. Now, here's another big one. This is part of the fiscal tightening that's coming on top of the monetary tightening. The Employee Retention Credit Program. That was a tax credit of up to $28,000 per employee. That was gone. That's gone. That's no longer. September 14th, you couldn't file an application any longer because the fraud was so rampant. So we have the lagged effect of monetary tightening coming in 2024. Corporate bankruptcies, by the way, are up 30% in the last 12 months. And S&P 500 companies have $107 billion in debt that has to be refinanced next year. Now, their average interest rate on that debt, Jesse, is 2.8%. 2.8%. So their interest costs are going to double next year. That's for IG credit. The situation is much worse with junk bonds, junk debt companies, zombies. 40% of the Russell 2000 don't make any money. They have to issue debt all the time. So this economy is a slow moving train wreck. And the train wreck is coming again in 2024.
Todd, do you have any thoughts or follow up on Michael's statements?
Listen, I'm fascinated by listening to him because he really eloquently puts the facts of what's going on. I mean, let's face it now. Again, I've been trading since 1980. I was a floor trader from 1980 to 2010. So I've been through a lot of these crashes. But the Dow when I started was 800. Okay, it's 35,000 now. Okay, so that's the inflationary cycle that we've seen, the explosion of nothing on air pockets. I mean, basically, in my terms, in my language, not as eloquently as Michael, but we have a house of cards. And this house of cards is going to blow down. And again, 2024, beginning, middle, I don't know. But I know that the facts that we're talking about today are real. They're not imaginary. We're not making them up. We're not bearish traders trying to get everybody to sell the market. We're talking about real facts of what's happening now. And what is happening now is massive amounts of debt. And people don't believe that we've lost a lot of jobs. In fact, I have a guy that yells at me all the time. You're full of crap that we didn't lose. I said, well, okay, whatever. I said, you can continue to read the BS labor statistics they give you, but those aren't factual statistics when you look at the bigger picture.
Well, speaking of a house of cards blowing down, when we look at the wind energy sector, in particular offshore wind, it's getting clobbered at the moment as the markets seem to be feeling the reality of the economics behind these projects, which are largely fueled by government subsidies. A lot of these companies asking governments for more money to continue with these projects. What are your thoughts on the so-called new green economy, what's happening with wind energy? Solar as well, we can put into that category, EVs, all of it. Is this green utopia that's being presented to us by the political ruling elite, is it going to come to pass in some way? Is this all just a road to nowhere? Todd, I'll start with you on this one.
Well, first of all, I am a non-believer in climate change. I don't think that it exists. Okay, I think there's a lot. I can give you all the statistics in the world that say it does or does not exist. I don't think it exists. But if it does, okay, let's assume that some of them are right. You're seeing every major company drop out of the climate accord because they realize that they're in way over their heads and they're nowhere near ready to move on to the next level. Wind energy is not nearly enough, nor is solar by themselves. And when you have an infrastructure, okay, and a power grid that cannot allow you to charge cars today, when you've got 5% or 8% of people driving electronic vehicles, how are you going to get to the rest? I only say this. If you want to steal my money in taxes and make me do all these things, give me the plan of how you're going to get there and how we're going to get there. Again, I don't believe that we are in a climate change environment, and because you've got China and India that represent 42% of the population, and they are never going to stop burning coal until they find a cheaper energy source. So are you going to put a dome over the United States of America or over North America to get the pollution? So we have way too many problems to deal with, and we should be still drilling our own oil here so that we can keep costs lower while they're trying to develop and fix the rest of it. But in my lifetime, I'm 66. Every presidential candidate has promised to fix the infrastructure. So far, zero have fixed the infrastructure. So in my eyes, it's a crock, and you can see it by the major countries that are dropping out, and you can see it by the lack of productivity here.
Yes, and good point about China and India. They've both announced massive build-outs to their coal capacity, while the West is fretting over any sort of fossil fuel.
Adding to their coal. Their coal is being mass produced more now than ever.
Yes, and Germany burning record amounts of coal due to their failed green energy policies. Michael, your thoughts on the new green economy?
Well, it's a bifurcated economy. Like Todd said, you got China and India. I don't think they're part of the green revolution. But then you have Brussels and you have the United States, who we've embraced green energy. It's no longer, as we said before, a market-based economy. It's artificial and driven by political expediencies. So I expect the governments in the developed world, and I'm talking about the United States and the European Union, to pursue green energy despite all of its inefficiencies for the foreseeable future, because they believe that global warming, whether I believe it or Todd believes it or not, is irrelevant. They believe that global warming is an existential crisis for mankind, and they will pursue these inefficiencies. And by the way, I wrote something years ago about how dangerous it is for the environment to produce these electric vehicles, because you're strip mining the earth for these rare materials, and then when you dispose the battery, all those chemicals leach into the soil, destroy the water. But I don't think they're thinking about this, because we're not dealing with a market-based economy. We're dealing with an artificial one that's based upon politics. So I'm not really invested in this area right now. It's something I wouldn't invest in, what I call sector one of my 5-sector model, which is disinflation and deflation and recession and depression, which is where I think we're headed next before the stagflation hits, maybe in 2025 or late 24. So it's not something I'm invested in now, and hope we can get to talk about what we can do now. But I mean, the green energy revolution is happening, despite how dangerous it is for the environment or how inefficient it might be.
Well, let's move on to that now, to talk about opportunities you both see in the market, or if you think now is a better time to be safeguarding wealth. Is this a time to just be sitting in treasuries, sitting in a money market account, making 5+% and waiting for the collapse of the market? When there's blood in the streets, perhaps there'll be some opportunities to pick things up for cheap. What are your thoughts? And Michael, I'll start with you.
So we touched on the valuation bubble. Let me just give you a couple of statistics. So the S&P 500 is trading at 18.5 times forward earnings. I love when Wall Street comes out and they always come out with these forward earnings. They never talk about the trailing 12-month earnings. They always talk about forward fictitious earnings, which will never happen. But let's just say, and that, by the way, Jesse, that earnings projection is a 12% growth rate for 2024. Now, real GDP is going to be about 2%. And if you look at earnings growth historically, it's been about 1.5 percentage points above real GDP. So I would expect earnings growth, if we have this perfectly soft landing, which I am predicting is going to be a crash landing. But if we have a soft landing, you can expect GDP growth nominally to be around 4% and earnings growth to be around there, 3.5 to 4%. We're already trading at 18.5 times that 12% growth rate. There's just no room for error here. The market is fully valued. Now, I'll give you another statistic. The total market cap of equities as a percentage of GDP is right now 160%. That is greater than any other time in history prior to 2020. If you look at the average of that metric, it's usually around 80%. So we were at the peak at the end of this cycle when I went bearish. I was not bearish in 2021. All right. We weren't not bearish at Pento portfolio strategies in 2021. I went bearish at the end of 21, early 2020, where the total market cap of equities to GDP was 200%. Let me give you another metric as to why I want to be cautious. I'm not going to speak for Todd, but I'm gleaning that he might be a little cautious here too. The S&P 500 dividend yield is 1.5% right now. That is 4.75% below the T-bill rate, percentage points below the T-bill rate. Now, the T-bill rate currently enjoys the advantage that T-bill rates have over dividend yields 175 points greater than it was at the start of the Great Recession and global financial crisis. This is the most artificial bubble in stocks. And you could throw the bond bubble in there, which is currently fracturing. And then when you throw the housing market on top of that, you have a triumvirate of bubbles that are going to break in 2024. And I love this statistic. I already talked about, I believe, about the home price to income ratio being at the highest level it has ever been in history. And that includes a rate that is much higher than it was at the apex in the summer of 2005. But 25% of all houses are owned by Wall Street and investors.
BlackRock.
Blackstone. Now, if Blackstone has to start dumping these homes because the unemployment rate starts to rise, and now the rents aren't there anymore, and the principal of these homes are dropping, you could see a flood of homes on the market. And I love to hear people talk about, there's no supply, there's no supply. Yeah, there's no supply because Wall Street bought it all. And they claim to be doing this for the good of people because they wanted to buy homes so they can rent it to people. I mean, this is what Blackstone came out and said. They were doing the middle class a favor by taking up, borrowing money, rates at near zero, buying up single family homes, entire tracts of single family home developments, especially in the Sun Belt, and then renting them out to people. What a wonderful thing. They get wonderful income stream, raising the rents on these people. And by the way, the balance sheet looks terrific because the home prices are going through the roof. That's when that reverses, you're going to see a ton of supply. So you have a triumvirate of bubbles, bond bubble breaking, you've got the stock bubble that's going to break, and you have the real estate market breaking. And we have never had all three in a bubble at the same time. It was the NASDAQ bubble of 2020. Then it was the the mortgage-backed security bubble in 2008. Now we have all three held together by what? Free money, cheap money, minus 8% real Fed funds rate for years and years and years. But now that rate's a positive 2%. And you're seeing that train wreck of the economy coming, and that has to bring down one of the most overvalued equity markets in history.
So are you then sitting on the sidelines in fixed income? What are you doing with your portfolio?
Okay, so right now
what
we
can you
have,
let us know?
so I'll give you the Pento portfolio right now. We are about 70% in T-bills. We have physical gold, and we have defensive stocks. And we're waiting for my model to signal when the stress in the credit markets and the financial conditions have tightened enough for us to go on board what I call the four horsemen of the economic apocalypse. And that's sector one, which is a deep deflationary condition and a recession/depression. Think about 2008. I think we very well could be headed there. In fact, I think if I had to pick a time frame, I would say Q1, Q2 of next year is when we really run into a problem with the bond market and the liquidity there, as I was talking about the RRP facility. And that's cash, treasury bonds, long the US dollar, not against gold, not against anything else, against the horrific fiat currencies of the euro and the yen. And then I short the market. Then I start to become in a net short position in the stock market. I have avoided that because the model told me, hey, listen, despite all the things that we talked about, that Todd and I have talked about on this format, financial conditions are still easing. The spread between junk bonds and treasuries is below 4. How in the world is this not, all the stuff we talked about, not affecting the credit markets yet? But the credit markets lead, they don't follow, it's not concurrent, they lead the equity market. And when I see those, I have my own proprietary metrics here. When I see those two things crack, and again, those are the credit markets and financial conditions index that I have, I will short the market. And if you have those four things, the four horsemen, you can make money in a bear market. And if you can make money in 2000, 2008, 2018, 2020, 2022, if you could do that, you're going to preserve your retirement. And you're going to be in a much better position then to deploy your assets once this what I call this grand reconciliation of asset prices consummates.
And Todd, what are you doing in terms of your own portfolio? I believe you are more of a short-term trader, but you also do take long positions.
I'm a trader. I'm a trader. I'm an investor. I teach it. I do it. But I'm always long equities, but I'm always hedged using option derivatives because you can hedge each individual stock to itself. And I've actually automated that method that I continue to buy and sell. But from a trading standpoint right now, I'm long, believe it or not, right now, but very, very scary, waiting for the turn Okay, because we've been long and short, and I will be ready to get short. And I do believe that the short side will be the right side. And I am very heavily invested in T-bills, in CDs at 5.65%. The stock market dividend, and what we forget about the dividend that's in the stock market is one other big factor, is that there's risk to the stock. You know, when you put your money in the bank, when you put your money in a CD, the risk is not there. Okay, it's covered. But when you put your money in the market, sometimes those dividends go much higher because the stocks get clobbered. So they got to pay more money on the dividend. It's a metric that is not healthy. Michael has nailed it as good as I could do myself. I couldn't even say it better. He's much more eloquent at saying it. And I do believe the markets are going to collapse.
Well, before I let you both go, this is the Vancouver Resource Investment Conference channel. So I would like to get your thoughts on commodities here. And Michael, I'll start with you. How do you see commodities positioned? I know you have your own proprietary model, and there's a point in that model where you do become bullish commodities. Are we there, or when do you see that happening?
Well, commodities aren't monolithic. It's not a homogeneous category. So there's base metals and energy on one side, and then there's gold, which is money, on the other side. The gold, silver, platinum. So in sector one, in deflation and recession and depression, physical gold is what you want to own, not the miners, because the miners are stocks. And all stocks go to a correlation of 1 in sector one. And even gold for a short period of time could be used as a liquidity instrument when you need cash, because all these financial institutions need, what they need most of all is dollars. They need money. They need liquidity. So they sell everything. And that will include shitcoin and anything else you could sell, anything they hold. But on the other end of this debacle, I believe you're going to have stagflation, intractable, protracted stagflation for a very long time. And that's when you want to probably, add, I don't say probably, definitely add base metals and energy in an overweighted capacity, because that's one of the best hedges against inflation. Not deflation, inflation. They get killed. Oil prices get murdered in deflation. So I look at it in both between growth commodities, which are copper, oil, natural gas, uranium, all that other stuff. That's on one side of the ledger. And then you have money, a currency with lower volatility dynamics than the rest of those commodities. That's gold. So I own gold now. That's the only commodity I will own until after post this next collapse.
And Todd, your thoughts?
This next iteration of collapse, which are occurring more frequently and with greater intensity.
Well, I'm an owner of gold, silver, and platinum, and I do think that is the right way, but it must be in physical. I don't believe there's enough gold and silver in the world to cover the paper that's out there. So I think that would create a problem. Everybody who's counting on paper to help them is going to be in for, I think, a rude awakening, whether they're buying through the futures market or they're buying the ETFs, whatever they're buying. I don't think there's enough. You own physical metals. I am a big fan of these soft commodities in the grain markets right now. And I think those are at prices, again, if they don't take care of grains now, if we don't see some price rising, I think the value for the buyer as an investor is a great buy here, because either there's going to be a shortage created or there's going to be a better economy. I believe there's going to be a shortage created. And one thing about consumable commodities, we need to eat. They got to be used. And that's where I'm looking at. So I'm looking at the soft and the grain markets right now, as well as gold and silver and platinum.
But Todd makes a great point. Before I just want to say, when I say gold, when I say gold, I think you start with 5% physical gold, 5% of your net worth. And when you say ownership of gold, people own gold because they don't trust the currency. They don't trust the banking system. So then they go off and they buy a bunch of gold and they store it in a bank somewhere, in a vault somewhere. I never, in another country even. I don't understand that. I mean, try calling up Carrie Lam in Hong Kong and say, by the way, you're storing me a bunch of gold for me over there. Is that okay? Call the Chinese government and see if they'll allow that to, ship me some of that gold. It's ridiculous. If you want to own gold, own it. There's two kinds of gold. There's gold you have to have physically, and then there's some kind of investable gold too. So I toggle the difference between investable gold between 0 and 20%, because I call it liquid paper gold. You can get in and out of it when you need to. But there's a certain percentage of physical gold you should have as a legacy for your children and your grandchildren. And that's something that you should never store. Todd is exactly right. That's why I'm, augmenting his what I believe were his thoughts, are underwriting what he said. You have to store it in a place that's not trusted by a third party, because that's why you own gold in the first place.
Yeah, completely agree with that. And some awesome thoughts shared. It's been a really enlightening conversation. Thanks to both of you so much for coming on the show. Before I do let you go, Todd, tell us about Bubba Trading and anywhere else you'd like to direct people online.
Well, actually, Bubba Trading, I'm a trader. I've been a professional trader since 1980, floor trader for 30 of those 45 years. And I do some educating now, and anybody who wants to get a little bit more information, I do a Monday night strategy call, but certainly just go to bubbatrading.com and you can check it out. If you've got any personal questions for me, just email me at bubbatrading.com. I'm happy to answer any question that you have.
I'll put all that in the description below. Michael, tell us about Pento Portfolio Strategies and anywhere you'd like to direct people online.
So the website is pentoport.com, P-O-R-T.com. I have a 5-week free trial for the midweek reality check. It's $50 a year. If you like it, it gives you the real economic data that you should be paying attention to, that you probably won't hear on the mainstream financial media. Or if you do hear it, you'll get their spin, which is useless. Like retail sales. Retail sales beat the number. Well, retail sales was negative for the first time in the last 7 months, and retail sales is a nominal number and it's falling. That's what you really should be talking about. So you get the real facts. And if you have $100,000 to invest and you are a U.S. citizen, I will take care of your money personally. And the website, again, is pentoport.com. The email address here is mpento@pentoport.com. The number for the office is 732-772-9500.
Great. Well, I'll put all that in the description of this video as well. Thanks once again to both of you for coming on. It was a ton of fun.
Thanks, guys. Thanks, Michael. Thanks, Jesse.
Thanks, both of you. Great to be on with you.
Crisis and Chaos, the Changing World Order, an exclusive live online video event on November 30th. Click below to purchase your ticket now.